You know, folks often come to me asking, Jesse, when do you know a move is over? How do you see the end coming before the crowd does? And I smile, because that question, though simple, is what separates the winners from the lambs. It's not about catching every penny of a run. No, it's about knowing when to hold on and when to step aside before the rug is pulled. In fact, today's talk ties directly to the previous video on how to predict the next breakout trend. We talked then about spotting the beginning of big moves. But just as important, maybe even more important, is learning when that move has run its course. Because a trader who can't step aside at the right time will give back everything he made on the way up. Now ask yourself, how many times have you watched a stock run up, felt smart riding it, only to hold just a little longer, and then suddenly your profit vanished? Doesn't it sting? That's not just bad luck. That's ignorance of the signs. And the signs are always there if you train your eyes to see them. The market whispers first, then it talks, and finally it shouts. By the time the crowd hears the shouting, it's too late. The first thing I always look at is volume. Prices don't move without money behind them. A trend that's alive and healthy breathes with heavy volume. But when you see prices climbing with shrinking activity, that's a tired move. It's like a fighter throwing punches with no weight behind them. Looks the same at first glance, but you can tell the strength is gone. Have you noticed how often near the end, prices can even surge to new highs, but the trading is thin? That's not conviction, that's exhaustion. The big operators are already out, and the little fellows are left buying from one another. And then there are those sudden, violent reversals. You'll see a stock that's been climbing smoothly for weeks suddenly drop sharp one day on high volume. The crowd shrugs, says it's just a correction. But if you've been watching, you know better. Why? Because trends end not in a whisper, but in a crack. That sharp break is often the first gunshot in a retreat. Tell me, how many times have you brushed off that first break, thinking it was just noise, and later wished you'd listened? Let's talk about the tape, because the tape never lies. You'll see hesitation on the ticker. Instead of steady climbing, you'll notice stalling, backing and filling, aimless action. It looks like the stock wants to move but can't muster the energy. That's a sign the big hands have withdrawn. And when the professionals pull their money, you don't want to be the last fellow at the card table. But here's the cruel trick of the market: it tempts you at the end. Many times, you'll see a final, desperate rally, a blow-off top as they call it. Prices soar, faster and higher than you thought possible, and the crowd piles in. They feel they're missing the boat. And that's when the trap is sprung. That last rally is often the very climax of the move. I've lived through it too many times. Back in my bucket shop days, I used to mistake that last surge for strength. Now I know it's the market's way of sucking in the greedy before the floor collapses. Are you beginning to see why discipline matters more than hope? Hope keeps a man in when the signs are all against him. Discipline tells him to step out, take his winnings and wait. That waiting, it's the hardest part. But it's also the part that makes fortunes instead of wrecks them. Think also of market leaders. In every bull run, there are a handful of stocks that lead the charge. When those leaders falter, that's the market whispering the party is almost over. A trader who only watches the averages misses the finer detail. But a trader who watches the generals, the big names, driving the move, he can tell when the army is losing momentum. Ask yourself this: would you rather listen to the speeches of the soldiers or watch the generals walk off the field? And psychology, don't ever discount it. At the start of a trend, the public is skeptical. They doubt. They hang back. That's when the professionals buy. As the move progresses, more and more join in. By the end, everybody's bullish. Your cab driver's giving tips, and your barber is buying stock. That's the surest sign the top is near. Because if everyone is already in, who's left to buy? Have you seen this yourself? The chatter grows loudest at the very end. That's no accident. That's the law of human nature. Now remember how in our talk on spotting breakouts, I told you the strongest moves begin when the public least expects them. Well, the reverse is true too. The weakest endings come when the public is most convinced the move will never end. That's why I tell you, don't follow the crowd's words, follow the market's actions. Another point, the market builds habits, and then it breaks them. Watch a stock in a trend. It may rise, then rest, then rise again in a steady rhythm, but near the end, that rhythm breaks. Instead of short, sharp consolidations, you get longer, weaker drifts. The tempo slows. Just as a man tires after a long day, a stock tires after a long trend. The rhythm tells you more than the headlines ever will. And do not forget stop losses. Some of you think stops are just protection against disaster, but stops also teach you discipline. When you place them wisely, you force yourself to act when the signs show weakness. How many fortunes have been lost because a trader told himself, just a little longer, it'll bounce back. The stop would have saved him, but he lacked the will to use it. I've said before, no man can consistently pick tops and bottoms. That's gambling, not trading. But a trader can read when the probability shifts against him. That's all you need. If you sell when the signs show exhaustion, you may leave a few points on the table. But those last points belong to someone else. Do you want pride, or do you want profits? Now let me tell you something about money itself. Your capital is your soldier. Every dollar you risk is a fighter in your army. Do not send them to a losing battle. When the trend is over, pull them back. Conserve them, because the next opportunity will always come. The market is never done offering chances. But if you waste your capital at the end of a move, you won't have the strength to seize the next. Isn't that the tragedy of most traders? They win, they lose it back, and when the real chance comes, they're broke. Here's another observation: the market at the end of a trend grows more volatile. Wide swings, whipsaw action, false breakouts. That's the battlefield growing chaotic. It's the market telling you the certainty is gone. And without certainty, you have no business being committed. Trade only when the odds are heavily in your favor. Anything else is speculation in its worst form. And remember, prices don't fall just because they're high, nor do they rise just because they're low. That's a fool's thinking. A trend ends when the force behind it is spent, when the operators who drove it are satisfied, and when the crowd has taken the bait. Until then, it may keep going farther than you imagine. But once those conditions align, no power on earth can keep it alive. The market doesn't care about your opinion, my opinion, or anyone's opinion. It cares only about supply and demand. Do you respect that law, or do you fight it? That's why I tell you, don't try to outsmart the market. Don't predict, observe. The signs are there for anyone willing to look. Volume thinning, leaders faltering, public excitement peaking, volatility rising. Those are not coincidences. They are the smoke before the fire, and a wise trader steps aside when he smells smoke. Let me ask you, what's harder, admitting a move is done, or holding on in blind hope? The first wounds your pride, the second wounds your pocketbook. And pride won't pay your bills. You've probably heard me say before, the market never changes in its essence. The faces change. The names of the stocks change, but the game remains the same. And one of the clearest lessons I've learned, again and again, is that the market gives you warnings before it turns against you. One of the most powerful of these warnings is what I call the sharp break on unusually high volume. That, my friend, is the first crack in the wall. And if you ignore it, you're playing against time, against mathematics, and against yourself. Think about what it really means. A trend, whether it's moving up or down, is fueled by the willingness of large interests to commit heavy sums of money. When the big operators want higher prices, they absorb everything the public throws at them and keep bidding. It looks smooth and natural. When they've had enough, though, when they decide it's time to take their profits, the market suddenly behaves differently. You'll see a day where prices tumble harder than they have at any point in the trend, and the trading is heavy. It looks abrupt to the untrained eye, but it's not abrupt at all. It's deliberate. The professionals are unloading, and they don't care how obvious it looks. They're getting out. Have you ever been in a stock that's been climbing steadily, day after day, and then suddenly, out of nowhere, it drops like a stone on huge turnover? Doesn't it always shock you? You look around for a headline, for some news to explain it. But the truth is, you don't need the news. The tape gave you all the information. That break itself is the news. The selling is real, and it's urgent. The first mistake most traders make is brushing it off as a healthy correction. But tell me, does truly healthy strength crumble with such violence? Or is it a signal that the foundation has weakened? Now, let me tell you how I came to respect this sign. In my early years, I'd watch a stock run higher and higher, and when that first violent break came, I'd think, well, here's my chance to buy it cheaper. So I'd step in, proud of myself for being clever, and what happened? More often than not, the stock never recovered. It might rally a little, but the character was gone, and sooner or later, it broke lower still. My bargain purchase turned into a heavy loss. After enough lessons like that, a man learns. The market punishes pride and rewards humility. Sharp breaks on volume don't always mean the trend is finished right then and there. Sometimes the market will attempt another rally. But the texture has changed. The psychology shifts. Think about it, all the traders who bought near the top are now stuck, nursing losses, and they're eager to get out even. That creates overhead supply. Every rally is now met with selling pressure from those desperate to escape. And who's left to do the heavy buying? Not the professionals, they've already cashed out on that violent break. That's why so often the first big crack is followed by rallies that fail more quickly than before. Do you remember the way we discussed breakouts in the previous talk about how strong trends begin with clean, decisive moves? Well, the same principle operates in reverse. A decisive break on heavy selling is the market's way of announcing that the big money has changed its stance. Just as you respect a powerful breakout as a beginning, you must respect a powerful break as the beginning of an end. It's the mirror image of that principle. And let's talk about volume, because volume is the truth. A small drop on light activity can be ignored. That's just noise, a little fluctuation. But when a drop comes with the heaviest volume you've seen in weeks or months, that means something very different. It means urgency. It means the strong hands are rushing for the door. When the smart money exits, the small money is always late. And I ask you, would you rather leave with the smart money or stay with the crowd hoping it's just a hiccup? Picture the psychology behind it. The stock has been rising, perhaps for months. Confidence is high. The newspapers are bullish. The tips are flowing. Your friends are talking about their gains. Then, out of nowhere, the price collapses 5, 10 points in a day on massive turnover. That isn't fear selling by the public. The public doesn't act so suddenly. That's professionals unloading huge positions. The public only reacts afterward, when they see their profits evaporate. And by then it's too late. That one day is enough to shake the confidence of anyone watching closely. If you've lived through it, you know the feeling in your gut. I've seen men lose entire fortunes because they couldn't respect that first break. They told themselves it was temporary. They doubled down, thinking they were buying cheap. The stock would bounce, yes, but never with the same conviction. The rallies were weak. And eventually, another sharp break came, worse than the first. By then, those men had convinced themselves they were right, and the market was wrong. And the market taught them a final, costly lesson. Why does this happen? Because a trend, like a man, gets tired. It can't keep climbing forever. Each leg higher takes fresh fuel, new buyers willing to pay higher prices. At the end, the buyers are exhausted. The professionals know it, and they sell into the last stages of optimism. That violent break is the moment they stop supporting the market. It's like cutting the rope. Without them, the price collapses under its own weight. You must learn to recognize it and, more importantly, to respect it. Don't try to be clever. Don't try to outguess it. When you see a sharp break on record volume, take it as a serious warning. At the very least, lighten your position. Don't argue with the tape. The tape is always right. Do you think the tape cares about your opinion? Or your feelings? Or the hours you spent analyzing? It doesn't. It tells the truth in plain numbers. It tells you that sellers have overwhelmed buyers. That's all you need to know. Some traders get stubborn. They say, "But Jesse, what if it's a false alarm?" What if the stock comes back? Let me answer you plainly. If it does, you can always buy it again. The market will give you another chance. But if you hold through the break and it doesn't come back, you'll be wishing you'd listened. Which mistake would you rather make, missing a little profit or losing a big chunk of your capital? That's the choice every trader faces. Now, look at history. The great tops in the market were always marked by these violent breaks. In 1907, in 1920, in 1929, every major collapse was preceded by sudden drops on enormous volume. The patterns don't change, because human nature doesn't change. The public always comes in late. The professionals always leave first. The signs are written clearly if you care to read them. And what about the small stocks, the side issues? They often show the cracks even earlier. When speculation is hot, the weak stocks get bid up along with the strong. But when the tide turns, those weak ones are the first to tumble violently. They have less support, fewer strong holders. Watch them closely. Their sudden breaks can be the canary in the coal mine for the broader trend. So ask yourself this: do you want to be the man who hopes, or the man who acts? The one who tells himself stories to stay comfortable, or the one who respects the evidence on the tape? Every trader answers that question not with his words, but with his money. Distribution is one of those words you hear tossed around in trading circles, but few people really stop to study what it means in practice. To me, distribution is the quiet, deliberate unloading of stock by the big operators into the eager hands of the public. It is not a guess. It is not a theory. It is a fact that plays out on the tape if you care to watch closely. And when you see distribution taking place, you're looking at one of the clearest signs that a trend is about to end. Let's think about the psychology behind it. A stock has been rising for weeks, maybe months. The professionals were in early, buying heavily before the move got attention. As prices climbed, the news turned favorable, the brokers began to recommend it, and the small speculators, seeing profits in their neighbors' accounts, jumped in. By the time the whole town is talking about it, the professionals are no longer interested in buying. They are interested in selling, but they cannot dump millions of shares on the market in one go. That would crash the price and spoil their profits. So they distribute little by little, carefully during strength, feeding stock to the public while keeping up the appearance of health. Do you see how clever it is? The public thinks the stock is strong because every rally looks impressive. But if you watch closely, you'll notice that the rallies do not carry as far as before. The upward drives are met with heavy selling pressure. The volume is large, but the progress is small. That is distribution. The professionals are selling into demand, making sure the price holds up long enough for them to offload their holdings at favorable levels. Ask yourself, how many times have you seen a stock rally only to stall near the highs, churn for days or weeks, then fall off suddenly? Did you think it was just random? It wasn't. That was distribution at work. The strong hands were unloading to the weak, and once their job was done, there was nothing left to hold the price up. The market collapsed under the weight of the new, weaker holders. Distribution doesn't announce itself with a trumpet. It disguises itself as strength. The tape looks busy. The headlines are bullish, the brokers are optimistic. But the action tells another story. Volume surges on up days, yet the gains are minor. Pullbacks are sharp, rallies are labored. That imbalance is the fingerprint of distribution. If you rely on stories and opinions, you'll miss it. But if you rely on the tape, you'll see it plain as day. One of the greatest mistakes a trader can make is confusing accumulation with distribution. They look similar at first glance: lots of volume, price holding in a range. But the intention behind the action is completely different. Accumulation happens after a decline, when strong hands quietly absorb shares from discouraged sellers. Distribution happens after an advance, when those same strong hands unload shares to excited buyers. The trick is in the result. After accumulation, the stock breaks upward with vigor. After distribution, it breaks downward with violence. Which side do you want to be on? I remember in my own career, back in the old days on the floor, I'd watch stocks hit their highs and then just sit there, day after day, with enormous volume trading hands. At first I thought, This must be strong. Look at all the activity. But then I realized strong stocks don't just sit there churning. Strong stocks move. When a stock is stuck at the top, with big blocks being absorbed but no real upward progress, that's not strength, it's selling. It took me some painful lessons to learn that, and here's the cruel trick: distribution is designed to keep you comfortable. The pros don't want panic while they're selling. They want calm. They want optimism. They let the papers print bullish stories. They let the brokers spread rosy forecasts. They even allow small rallies to keep the public feeling safe. All the while, they're feeding out their shares like a butcher slicing meat. By the time the public realizes what happened, the professionals are long gone. Do you recall how I told you that every great move has its leaders, the generals of the campaign? Watch those leaders closely. When they enter distribution, it's not just about one stock. It's about the broader trend. Leaders are where the professionals focus their money. If the leaders begin to stall, churn, and show those heavy volume rallies that go nowhere, it tells you the distribution is underway across the board. That is a danger signal, and only a fool ignores it. Let's take an example in your imagination. Suppose a stock has risen from 50 to 120 over 6 months. Every dip has been bought, every rally has been strong. Suddenly, around 115 to 120, the behavior changes. The stock rallies hard on heavy volume, but instead of pushing cleanly to new highs, it stalls. The next day it drops back quickly. Then it rallies again, with just as much volume, and again it fails to make progress. The papers are still bullish, saying the company is doing well. The brokers say to buy the dips. But if you're watching, you notice the difference. All that effort, all that volume for so little reward. That's not demand, that's supply. That's distribution. Do you see why the public always loses? They buy into the very strength the professionals are using to sell. The crowd sees activity as proof of opportunity. The professionals see activity as their exit strategy. Two people watching the same tape can come to opposite conclusions, depending on their training. And in this business, conclusions decide who keeps their money and who parts with it. Distribution phases can last longer than you think. Weeks, even months. The market is patient. The professionals are patient. They don't need to rush. They let the stock move in a wide range, up and down, creating the illusion of opportunity. Each rally invites fresh buying. Each rally gives them a chance to sell more. Little by little, they transfer ownership from themselves to the public. And once the transfer is complete, the support is gone. That's when the real decline begins. So, what do you do when you suspect distribution? You act with caution. You don't argue with the tape. If you're long, you start scaling out. You don't need to pick the exact top. You just need to avoid being the bag holder when the professionals are through. If you're watching from the sidelines, you wait. You don't get sucked in by the illusion of strength. You let the distribution finish, and then you look for the next real opportunity after the break. The beauty of the market is that it always leaves footprints. Distribution is one of the clearest footprints of all, but it requires humility to read it. It requires you to accept that the public story may be false, that the optimism may be manufactured, that the strength may be nothing more than professionals using you as their exit. Many traders can't swallow that truth. They want to believe the story. They want to believe the rally. And that's why the market always has fresh victims. Now, ask yourself this: would you rather follow the stories or follow the money? The stories are for the crowd. The money is for the men who study the tape. Distribution is simply money changing hands, strong hands to weak. If you understand that, you'll never be fooled by appearances again. The blow-off top is one of the most deceptive and dangerous moments in all of speculation. To the untrained eye, it looks like the very moment of greatest strength. Prices soar faster than at any time in the entire move. The newspapers shout, the brokers cheer, the public scrambles to get in at any cost. But in truth, that last wild rally is not the beginning of riches, it's the end of the campaign. It is the final bait, the last lure cast by the market before it turns and devours those who came in late. Why does it happen this way? Because human nature doesn't change. The professionals, the strong hands, They bought in long before the excitement. They carried the stock up steadily, feeding the rally with their capital. But they cannot unload millions of shares quietly in the shadows. They need a frenzy. They need a mob of eager buyers willing to take stock off their hands. The blow-off top provides exactly that. It is a frenzy, a panic in reverse. Instead of rushing for the exits, the crowd rushes for the entrance, afraid of missing out, and the professionals sell to them with both hands. Have you ever felt that rush yourself? The stock you've been watching suddenly leaps higher and higher, every tick a new high. Your pulse quickens. You tell yourself you'll be left behind forever if you don't act now. That is the psychology of the blow-off. It preys on fear, not the fear of loss, but the fear of missing profits. The irony is that most who chase at that moment end up with nothing but loss. They buy from the professionals who are unloading, and as soon as the last eager buyer has taken his fill, the stock collapses under its own weight. In my early trading days, I fell for it more times than I care to admit. I would see a stock running wild, shooting upward, and I'd think to myself, this is the strongest thing in the market. I must get in. I would buy, often near the very top, only to find within days the stock had turned and I was trapped. It took me years of hard knocks to recognize the pattern for what it was. Now, when I see a sudden, frantic rally late in a long trend, I know enough to step aside. I let the public have their thrill. I know the aftermath. The tape tells the truth if you know how to listen. During a blow-off top, the volume explodes. Every uptick is met with a flood of transactions. But look carefully, the gains, though large in absolute terms, are unstable. They come in gaps, in surges, not in steady conviction. The market isn't advancing in measured steps. It's racing out of control, like a horse at the end of its strength bolting wildly. That's not healthy demand, it's desperation. Do you see the difference? A true healthy trend climbs steadily, with corrections, consolidations, pauses for breath. A blow-off top races ahead with no pause, because it's not built on discipline, it's built on panic buying. Think about the timing. Blow-off tops don't occur at the start of trends. They only happen at the end, after months of steady climbing, when the public has become convinced the move will never end. That's when the cab driver, the shoe-shin boy, the office clerk all begin to buy. Everyone is in, everyone is bullish. And at that very moment, when the buying is most widespread, the market produces one last spectacular rally to suck in the final holdouts. Then, with everyone committed, the selling begins. And with no new buyers left, prices tumble. I remember one campaign where I watched this play out perfectly. A stock had been rising steadily for months. The move was orderly, supported, the kind of action that makes you feel safe. Then, suddenly, it erupted. In a single week it advanced more than it had in the previous 2 months. The newspapers were filled with glowing stories about the company. People who had never owned a share of stock in their lives were rushing to buy. And what happened the very next week? The stock collapsed. It fell faster than it had risen, wiping out months of gains in days. The blow-off top had done its work. The professionals were out, the public was trapped, and the decline was merciless. Ask yourself, how many times have you seen it? A stock surges wildly, everyone is talking about it, and then, just as quickly, it collapses. Doesn't it always seem to happen when the excitement is loudest? That is no accident. That is the very definition of the blow-off. Excitement is the camouflage the professionals use to unload. If you let excitement guide your trading, you'll always be the victim. If you let the tape guide you, you'll learn to step aside when excitement peaks. Notice also the character of trading during a blow-off. The intraday swings grow violent. You'll see prices jump 5, 10 points in a single day, sometimes in an hour. The volatility explodes, but strength in the market is never reckless. True strength is calm, measured, deliberate. Wild swings mean instability, and instability is always a warning. The market at that point is no longer in the hands of the professionals. It is in the hands of the crowd. And the crowd, left to itself, always loses control. Another clue is the language of the public. Early in a move, the public is doubtful. They hesitate. By the middle, they grow optimistic. But at the blow-off, they become certain. They say, "This stock can never go down. It's a new era. You can't lose. Have you ever heard that kind of talk? That's the death knell. When certainty reaches the streets, the top is near. The market loves nothing more than to humble certainty. And let's not forget the broader trend. A blow-off top in one leading stock often signals exhaustion in the whole market. Leaders set the tone. When a leader blows off, it is the generals leaving the field. The rest of the army may linger, but their fate is sealed. Watch for it. Don't be distracted by the averages alone. The leaders will show you the truth first. You may wonder why not try to ride the blow-off for a few quick points. Isn't there profit to be made in those final wild rallies? Perhaps if you have perfect timing, but perfect timing belongs to gamblers, not traders. The risk is immense. One misstep, one late entry, and you're caught at the very top. The odds do not favor it. A trader who builds wealth is not the man who catches every last dollar. He is the man who knows when the easy money has been made and when the dangerous money is being dangled in front of him. The blow-off top is dangerous money, and it ruins more accounts than it enriches. So I tell you, watch for the signs. Sudden, accelerated advances late in a long trend.